Here's something wild. 73% of Americans think you need at least $5,000 to start investing in the stock market. That's completely wrong. And this myth is keeping millions of people poor. I'm going to show you 7 things about the stock market that nobody tells beginners. Things that Wall Street doesn't exactly advertise because, honestly, they profit when you stay confused. By the end of this video, you'll understand exactly how stocks work, how they actually make you money, and most importantly, how to avoid the mistakes that destroy beginner investors. And look, I get it. The stock market sounds complicated, intimidating, like something only rich people with finance degrees can understand. But that's exactly what they want you to think. Let's start with secret number 1. And this is huge. What a stock actually is. Because most people have no clue. When you buy a stock, you're buying a tiny piece of a real company. Apple, Microsoft, Tesla, whatever. You become a partial owner. That's it. That's what a stock is. Think about it like this. If you own 1 share of Apple stock, you literally own a microscopic slice of every iPhone, every MacBook, every Apple store in the world. Wild, right? As of July 2026, Apple has about 15 billion shares outstanding. So if you own 1 share, you own 1/15 billionth of the entire company. Tiny but real. Now here's why this matters. Companies exist to make profit. And when you're an owner, even a tiny owner, you get a piece of those profits. Which brings us to secret number 2. Secret number 2. There are only 2 ways stocks make you money. Just 2. And understanding this will save you from so many scams and bad investments. First way is capital appreciation. Fancy term for simple concept. You buy low, sell high. You buy a stock for $100, it goes to $150. You sell it and pocket $50 profit. Second way is dividends. Some companies share their profits directly with shareholders. They literally send you cash just for owning the stock. It's like getting paid rent for letting them use your money. In 2026, there are companies paying 4, 5, even 6% dividends annually. That means if you invest $10,000, you get $400 to $600 every single year just for holding the stock. Now, secret number 3 is controversial, but you need to hear it. Timing the market is basically impossible, and trying to do it will make you poor. Everyone wants to buy at the absolute bottom and sell at the absolute top. But study after study shows that even professional fund managers can't consistently do this. Research from 2026 shows that 90% of actively managed funds underperform the market over 10 years. 90%. These are professionals with teams of analysts, and they can't beat simply buying and holding. Here's what works instead: timing the market, not timing the market. The longer your money is invested, the more it compounds and grows. This is proven over and over. If you invested $10,000 in the S&P 500 in 2016 and just left it alone, by July 2026, you'd have around $32,000. That's more than tripling your money by doing absolutely nothing.
But if you tried to time it, jumping in and out based on news and fear, studies show you'd probably have half that. Maybe less.
Secret number 4 is my favorite because it destroys the biggest excuse people have. You don't need thousands of dollars to start. Not anymore. Thanks to fractional shares, which most brokerages offer in 2026, you could buy a piece of any stock with literally $5. $5. Want to own Amazon? Amazon stock trades at around $180 per share in July 2026. But you don't need $180. You can buy 0.02 shares for $5. And you get the exact same percentage returns as someone who bought 100 full shares. The math is identical. You're just starting smaller. Most people waste years waiting until they have enough money to invest. Meanwhile, they miss out on years of compound growth. Starting small beats starting later every single time. Secret number 5. The stock market has a dirty little secret called fees. And these invisible costs are silently destroying wealth for millions of investors. Every mutual fund and managed investment charges something called an expense ratio. It's a percentage of your money they take every year just for managing your investment. 1% doesn't sound like much, right? Wrong. Over 30 years, a 1% fee can eat up almost 30% of your returns. Nearly a third of your wealth gone? Here's real math. Invest $50,000 over 30 years with 7% returns. With no fees, you end up with $380,000. With a 1% annual fee, you end up with $280,000. You just paid $100,000 in fees. For what? Usually for worse performance than the market average. This is why index funds are so powerful. They charge as little as 0.03%. That's $30 per year on a $100,000 investment instead of $1,000. Secret number 6. Diversification isn't optional, it's essential. And no, owning 5 tech stocks doesn't count as diversified. Diversification means spreading your money across different companies, different industries, different types of investments. So if one thing crashes, your entire portfolio doesn't crash with it. The easiest way to diversify in 2026 is through index funds or ETFs. One purchase, instant diversification across hundreds or thousands of companies. It's like buying the entire market in one click. The S&P 500 index, for example, gives you exposure to 500 of America's largest companies. Technology, healthcare, finance, energy, consumer goods, everything. And here's the thing. Over the last 100 years, the S&P 500 has averaged about 10% annual returns. Not every year, but on average. That's wealth-building power. Secret number 7 might surprise you. The stock market isn't actually risky long-term. It's only risky if you panic and sell when things drop. Yes, the market goes down sometimes dramatically. In 2020, it dropped 34% in a month. Terrifying. But if you held on, you were back to even within 6 months and making new highs within a year. Here's a fact that should blow your mind. There has never been a 20-year period where the S&P 500 lost money. Never. Not through wars, recessions, crashes, nothing. So the risk isn't the market. The risk is your behavior. Selling when you're scared. Chasing hot stocks. Trying to get rich quick. That's what destroys wealth. The best investors are often the ones who set up automatic investments and then basically forget about their accounts. Boring beats exciting in investing every time. So what should you actually do with all this information? Step 1 is embarrassingly simple. Open a brokerage account. As of 2026, most major brokerages have 0 account minimums and 0 commission fees. Step 2. Start with an index fund. Something simple like a total market index or S&P 500 fund. Low fees, instant diversification, proven track record. Step 3. Set up automatic monthly investments. Even if it's just $25 a month. Consistency beats timing. Always. And step 4. Ignore the noise. Financial news makes money from panic and excitement. Your job is to be boring. Invest regularly. Stay diversified. And let time do the work. Look, I know this stuff can still feel overwhelming. That's normal. Every successful investor started exactly where you are right now. Confused, nervous, unsure. If this video helped you understand the stock market better, do me a favor and smash that like button. And subscribe to Operation Wealthy, because we drop new money skills every single week. The difference between people who build wealth and people who don't usually comes down to one thing. They started. They took action. Even if it was small, even if they were scared, they started. 10 years from now, in 2036, you'll either be glad you started investing today, or you'll wish you had. The choice is yours. Make it count.